Welcome to Market Thesis. This is your Friday macro thesis, the big picture argument behind the weekly noise. Today's topic gold versus stocks. One of these two markets is sending the most important macro signal of 2026. The other is ignoring it completely. Here is the data. Gold is right and stocks are wrong. That is a bold claim, and by end of this video, I am going to prove it with data. Not opinions, not predictions, the data that already exists, that most investors are not looking at. Let's begin. Look at this chart. The gold line, the blue line. Gold surged 48% in 2025. It's the single best annual performance since 1979. Spot prices reached an all-time high of $5,595 per ounce. And over the last cycle, gold has established a 2:1 outperformance ratio against the S&P 500. For every dollar the stock market made, gold made two. The asset that most financial advisors told you to ignore has quietly become the best performing major assets class in the world. But the performance gap is not the story. The performance gap is the symptom. The story is why. To understand what gold is telling us, you first need to understand the rule it just broke. For decades, gold maintained a strict negative zero point 0.8 correlation with the real yields. What that means in plain terms, when real interest rates rises, gold falls. When real rates fall, gold rises. The relationship was one of the most reliable in all of the financial markets. Look at this chart. The two lines move almost in the mirror image. From the left edge to the dashed line, gold up when yields down, gold down when yields up. Textbook for decades. Then 2022. The dashed vertical line on this chart is labeled as 2022 structural break. Real yield surged from minus 1.8% to the positive 2% in the fastest real yield spike in the modern history. Based on the historical pricing models, gold should have suffered a 58% fall. It did not. Instead, gold flatlined and then rallied all the way to $5,595. When an asset refuses to follow the rule that governed it for decades, when it ignores the headwind that should crush it, the market is telling you something that has changed at a structural level and fundamental level. Gold is no longer just an inflation hedge. It is something more fundamental, a hedge against the system itself. Now look at who is buying. This is the 10-year timeline of quarterly central bank gold purchases. Look at the final bar. In quarter 1 2026 alone, global central banks acquired $37 billion worth of gold, 244 tons, in a single quarter, the highest single ever quarter value on record. And 68% of the central banks surveyed are actively planning to increase their holdings further. Think about this. What does this mean? Central banks are the most sophisticated, most data rich, most risk conscious institutions in the financial global system. In the global financial system, they manage the reserve of entire nations. They are not speculating, they are not chasing performance. When they buy $37 billion of gold in a single quarter and plan to buy more, they are making a strategic decision about the long term reliability of fiat currency. They are replacing dollars with gold. The question every investor should be asking is, what do they know? It is not just central banks. Look at the staircase chart. Global gold ETF recorded 89 billion in aggregate inflows throughout the 2025, a record. Western institutional buyers, pension funds, hedge funds, asset managers added over 500 tons of physical gold to the global vaults. The market just recorded exactly 7 consecutive months of the sustained institutional ETF net inflows. This matters because for nearly 4 years of the following 2020 recession, Western institutional investors were net sellers of the gold ETFs. They were getting out. That trend has now fully reversed. The smart institutional money that was leaving is now arriving, and in record volume. When central banks and institutional investors are both buying the same asset simultaneously in record quantities, you must have to pay attention here. Here is why institutional capital is moving into gold. I am going to explain it now. Look at the left chart, stock versus bonds. The tight diagonal cluster tells you everything. Stock and bonds are moving together at their highest correlation in 30 years. For 2 decades, the 60-40 portfolio worked because when stocks fell, bonds rose. They moved in opposite directions. The bond allocation was your protection. That protection no longer exists. In this environment, with inflation elevated and the Fed trapped, stock and bonds fall simultaneously, there is nowhere to hide inside a traditional portfolio. Now look at the right chart, stock versus gold. The scattered cloud dots shows a correlation of just zero point 0.1 to 0.3%, near zero, almost no relationship at all. Gold moves independently of the stock market. When stock falls, gold does not follow. When the traditional portfolio stops working, gold is the only major asset class that still provides the true diversification value. Institutional capital is not buying gold because they think it will go up. They are buying gold because their portfolios are broken. Gold is the fix. Now, for the deepest driver, the one that tells us that is not a temporary dislocation. This chart shows US sovereign interest payments over the last 5 years, 500 million. That is where interest payments started, $1.2 billion. That is where they are today. In exactly 5 years, the cost to service US government debt more than doubled. The dashed red line across the top is the threshold that the European Central Bank formally labeled that the debt doom loop, the point at which interest consumes one-fifth of the all government revenue. The US has crossed it. This is the parallel to the UK in 1940s, when Britain emerged at the World War II with an unsustainable debt burden and deliberately chooses to debase its currency. It sacrificed sterling reserve status to make its debt manageable. The US faces the same arithmetic today. The debt is too large to pay down, the deficit is structural, not cyclical. The only exist are default, austerity, or the currency debasement. Gold's 5,000 year rule is the store of value that no government can print more of. When sovereign debases currencies, gold goes up, not as the prediction, as a historical fact. Equity markets are ignoring reality. While gold is pricing in sovereign debt risk, currency debasement, and the structural uncertainty that stock market is trading as if none of this is happening. The S&P 500 currently trades at 22 times forward earnings. The 20-year historical average is 16.1 times. This is a 36% premium above the long run average, 36% above the average into a rare environment where the Fed is considering hiking, where sovereign debt is in a spiral, and where the bond market is flashing warnings that we already covered on Tuesday. And look at what is holding this market up. The Magnificent Seven tech stocks prop up 37% of the entire S&P 500 index. 7 companies, 37% of the index, the most concentrated equity market in the modern history, when 37% of the index depend on just 7 companies priced for perfection. And those 7 companies are the most rare sensitive stocks in the market. The risk is not diversified, it is concentrated. And at the bottom of the slide, one final line, aggregate margin debt at all-time record levels. Investors are borrowing money to buy a stock at the most expensive valuation in 20 years. That is not confidence, that is leverage, and the leverage unwinds fast. History does not repeat. But look at this chart. The gold line is in 1970s. Gold went from $35 per ounce in 1971 to $850 per ounce in 1980. A 24 times move in just 9 years. The gray line overlaid on it, that is 2025. Gold's explosive 48% trajectory in 2025 mathematically matches its historic 1979 breakout performance. The two lines tracked almost identically, and what happened to the stocks during 1970s while gold was making that a 24 times move? The S&P 500 delivered negative real returns for a macro full decade, not a bad year, not a correlation, a decade of negative real returns. The macro condition then and now, oil shock from the geopolitical conflict, check. Inflation reaccelerating, check. Fed trapped between hiking and cutting, checked. Sovereign debt concerns, check. Dollar losing reserve status, check. Gold breaking correlation and rising, check. The last time gold performed exactly like this, it was 1979, the year before the final explosive leg higher. The new macro regime dictates returns. Let me be direct about what this means for every major asset class. Look at the top left quadrant. Gold up. Physical metals act as the ultimate sovereign hedge, drawing relentless central bank accumulation precisely because they cannot be debased. The trend has fundamental institutional support that does not reverse quickly. Bitcoin up at the top right quadrant. Decentralized digital scarcity acts as the high beta co-beneficiary to gold in the macro regime, not a competitor to gold, a parallel. Both benefit from the same thesis. Distrust of the fiat currency, Bitcoin amplifies the moves. Look at the bottom left quadrant. Stocks down. Equities faces extreme 22 times valuation risk while the fiat dollar suffers inescapable debasement. The very currency stocks are priced in is losing purchasing power. 22 times expensive valuations into a structurally weakening currency is a compounding problem, not a manageable one. Look at the bottom right quadrant. The dollar down. The fiat dollar suffers inescapable debasement under the unprecedented debt burdens. Sovereign debt spiral we looked two slides before has no clean exit. The only question is the pace of debasement and not whether it continues. Two assets going up, two going down. In the new macro regime system, regime matters most. That company earnings more than the analyst targets, more than the quarterly data. One of them is right. The divergence between the record high gold and the equity market complacency signals an imminent systematic reknocking. Let me close. Gold is at record high. Stocks are at 22 times forward earnings, 36% above their historical average valuation. These two things cannot be right, at the same time. Gold is saying the sovereign debt spiral is real, the currency debasement is the structural thing, and 60-40 portfolio is broken. The fiscal math does not work. Stocks are saying earning will grow, AI will deliver, the Fed will cut eventually, everything is fine. Right? Not right. One of them is right. The data says it is gold. The central bank says it is gold. The institutional capital flow says it is gold. The broken correlation say it is gold. The 1970s say it is gold. The question is not whether you should pay attention to. The question is whether you can afford not to.